In financial economics, incentives don't just shape individual decisions, they ripple through entire systems. Beyond individual incentives, financial systems create new challenges. These are systemic and emergent, ripple effects that reshape markets in unexpected ways. The first problem is bailouts, or too big to fail. When institutions are so large and interconnected, they expect a rescue if things collapse. This creates a dangerous incentive: take bigger risks, because losses may be shared with the public while profits remain private. Next comes speculative incentives. Markets often reward speculation, short-term trading for quick profits, over long-term fundamentals. This chase for speed and gains can inflate bubbles and ignore real economic value. We then move to agency conflicts in financial intermediaries. Brokers, banks, and clients tug on the same rope in different directions. Financial intermediaries act on behalf of others, but layers of incentives don't always align. A broker might push high-fee products, not what's best for clients. These misalignments build, creating hidden risks in the system. The fourth issue is liquidity versus solvency incentives. A bank balances on a tightrope over piles of coins on one side and deep water on the other. Markets pressure firms to maintain liquidity, cash to meet today's demands. But focusing only on the short term can weaken long-term solvency, leaving institutions fragile. The incentive to survive today may endanger tomorrow. Now comes regulatory arbitrage. A bank sneaks through a loophole in a wall of rules. Regulations aim to protect the system, but firms often exploit gaps, shifting activities to less regulated areas. This rule shopping keeps profits flowing but increases systemic fragility. The sixth challenge is mispricing and incentive distortion. A balloon labeled stock prices inflates as eager investors pump it up. Bonuses, earnings targets, and short-term incentives can drive asset prices far above their real value. Markets inflate because incentives push them higher until the balloon inevitably bursts. Finally, herding and career concerns. A crowd of investors mimics each other's moves, forming bubbles overhead. Analysts and managers may prefer to follow the crowd rather than risk standing alone. After all, careers feel safer if everyone is wrong together. But this herd behavior amplifies risks, turning small ripples into systemic waves. Systemic and emergent incentive problems reveal that markets are not shaped only by rational individuals. They emerge from complex interactions. Understanding them is key to navigating financial systems safely.